come on. Okay. So, let's see, where's the rest of the pairs trade? So I guess that's pretty much it on the pairs trades. And what we'll do is we'll take a look after the statistics come out.
Sorry to interrupt. We'll proceed with
there
the
you go.
data release. Yep.
No problem. You ready to roll?
You will see. Yes. I'll see you very soon. Okay, hello everyone. I'm very happy to have you all here because right about now we should start discussing the U.S. durable goods orders and core durable goods orders month-on-month data. It will be me and Max here today with you. And according to Bloomberg, the U.S. durable goods orders month-on-month data are forecasted to be at -1.5%, and the prior figure still stands at -2%. The positive trend in the number of orders for long-lasting equipment stalled in August amid volatility in financial markets and concerns that global growth is slowing. Orders excluding transportation equipment remained flat after rising 0.6% in the previous month. Orders for all durable goods plunged 2%, mainly due to declines in defense and aircraft. And nevertheless, both capital goods orders and shipments are expected to rebound in the third quarter. Durable goods orders are forecasted to decline 1.1% according to Forex Current, while core orders are expected to remain flat. Talking about the forecast more particularly, I would like to pay your attention to the economists surveyed by Bloomberg on the matter, and according to their views, we have the survey summary where the median estimate stands at -1.5%, average estimate stands at -1.58%. High estimate stands at 1.1%, low estimate stands at -5.5% respectively. Hello Marcello, nice to see you here. And number of estimates this time has reached 77. And right now you can see guys out there the Dukascopy community members poll. And their expectation in regards of the US dollar, Japanese yen currency pair. And according to their views, you can see that the majority went with the bulls this time. You see 3.33% versus 46.67 percent bearish votes. You can see hopefully a couple of comments from our community members. And meanwhile, I would love to share a comment from Sam Rowe, Business Insider, who says that the Fed will mull over monetary policy and the economy at its next Federal Open Market Committee meeting, which will be held on Tuesday and Wednesday. With market volatility elevated and global growth slowing, most economists see the Fed leaving easy monetary policy unchanged with near zero interest rates. Indeed, dovish commentary from Fed Lawyer Bernard and Mr. Tarullo suggests that we wait until 2016 to see anything happens in terms of tightening. The growth picture has been worse than expected since the September FOMC. Goldman Sachs' David Merkel said on Friday the October meeting is unlikely to resolve questions about recent dovish comments from governors Bernard and Tarullo. Although their comments have been widely interpreted as implying that a hike this year is unlikely, we instead see their remarks as reflecting reasonable and predictable disagreement, and we continue to expect a liftoff in December, though only with a 60% confidence. And Thursday comes with the government's first estimate of GDP. In Q3, again, Wall Street economists have been prepping their clients for a weak number. Okay, I guess that pretty much is it on the fundamental. I hope you had a chance to read the comments and the the whiteboard, and I would love to pass the floor to Matt, who's going to cover the technicals. Please.
Thank you very much, Paulina. Hello, everybody, once again today. So we have as Paulina has just said, we have the U.S. core durable goods orders data today. And the expectation actually is not very optimistic for today. The majority of market participants expect the headline reading to decline for the second consecutive month. For instance, Goldman Sachs expects the reading to decline by enormous 4 percentage points, while Bank of America and Commerzbank, they expect a decline of 3.5%. Concerning the core reading, for instance, Credit Suisse expects a decline of 0.5%, even though the average expectation stands at 0 after a decline of 0.2% back in August. And therefore we have the negative surprise trading strategy today and the euro-dollar currency pair for the purpose of discussion. This currency pair has a buy market according to the strategy, or the sell market for the US dollar. Speaking about the market sentiment, actually at the moment for this currency pair, the sentiment is quite neutral. As you can see, slightly more than 50% of all trades are bullish on the euro and bearish on the US dollar. At the same time, the pan-US dollar sentiment, if we take into account all the currency pairs with the US dollar, the sentiment on this currency is still bearish in the majority of all the cases. Now let's move on probably to the discussion of the current market situation. We see that the current trading level of the pair is 1.1072, and in the last couple of minutes the pair has been ticking up slightly, possibly already pricing in the upcoming data release, which will be the numbers will be out in about 3 minutes from now. And of course, as usually, to project the possible market reactions after the data is released in 3 minutes from now. The first market reaction, let's have a look at the previous ones, which we have had in the last 5 months from now. And as you can see, for the euro-dollar currency pair, the reactions ranged from 40 pips back in May and down to just 5 pips we have seen in September. So it was quite an unusual month when for such kind of important data we used to have very small market reaction, but hopefully it will not be the case today. Concerning the average reaction, it actually used to be 22 pips. If we speak about the take profit and stop losses for today, the first take profit is placed at the level of the daily R1 resistance line, which is supported by the 4-hour R2 resistance line at 1.108385. While at the same time, if we get much worse than expected numbers today, it is possible that we'll have stronger reactions from the euro-dollar currency pair, and the pair may surge above the major level of 111. The level which hasn't been surpassed in the 2 past days after the euro actually has declined significantly in the end of the previous working week when we have had this ECB meeting, as you may remember. Speaking more about the stop loss level, returning back to that, the first stop loss is placed around the daily pivot point at the moment, at 1.1045, which is some 30 pips below the current market price. We have 1 minute exactly to go till the data will be released, will be coming in, and we'll see the numbers eventually in the chat section. Let me mention the technical indicators for the euro-dollar currency pair. The 10-minute indicators are actually pointing to the upside, and they support the bullish stance on the euro-dollar currency pair, and they support the trading strategy. At the same time, the 30-minute indicators are slightly bearish at the moment, so somewhat mixed situation from the indicator's point of view. But of course, it will all depend on the numbers. Some analysts say that they may decline because the aircraft orders have declined significantly in September. But we will see. We will see that in a couple of seconds. I think we have left 10 seconds left till the data will be released, and we will see the first market reaction, hopefully, from the euro-dollar currency pair. So let's just wait for the first numbers to come through the chat section. Actually, we see not that strong market reaction, actually almost no market reaction at the moment. So concerning the headline reading, the actual number is -1 percentage point, which is actually better than expected. The average expectation was -1.2 percentage points. In September, it is better than -1.5% expected, and it is slightly better than, if I may say so, better than -2.3% decline we have seen back in August. While speaking about the core reading, there the actual data is unchanged, so 0% change for the core orders in September. And actually, the market reaction wasn't that strong. There was almost no significant market reaction on this data because the swing from the expectation also was not that strong at all. And I think now we have some edited data in the chat section. So the actual August data was revised considerably to the downside to -3% for the headline reading and to -0.9% for the core reading. But as you can see, almost no reaction, no significant reaction from the euro-dollar currency pair, quite a surprising one, but the pair has ticked still somewhat to the upside in the past couple of minutes, in the past 10 to 15 minutes, but not that strong reaction to say anything additional about that. Okay, I guess that will be all from my side now on the technical part for this data release. Thank you very much for your attention. I wish you all a great day ahead. See you all tomorrow, and I give the floor back to you, Polina.
Thank you, Max. I must say I'm a little bit shocked. I was expecting even worse numbers than the Bloomberg was. I don't know if it's been pessimistic Tuesday for me or not. However, yeah, we're still not in the best position. The U.S. economy is not. However, I don't know, Doc. Well, what do you think? I'd love to hear that. Yeah, and thank you.
It's kind of. Can you hear me? Oh, okay, good.
Yeah.
Pretty much the stock market, over here, the equity market has made a little move. Looking on the pairs trades, I'm trying to interpret it too. You can see there's the euro, the yen has dropped a little bit. Let's see where the euro is at the moment. Pretty much, okay. So the euro is perked up from it. Again, there's that feeling that. First initial feeling was, okay, they're not going to raise because of that, because the back month also was adjusted. Then you got to wonder what is money looking for at the moment? Money is fleeting. It's always moving around looking for a new place to park itself. And so the numbers basically are telling them that the economy is not going anywhere particular. The central bank is not going to raise rates tomorrow or suggest that they're going to raise rates, and probably they're waiting for is a Draghi moment, like the way Draghi was last week. They're probably waiting for some type of statement, and so we shouldn't see too much action out of it. I don't see, they've drifted off a little bit, but overall, I would say that after the initial few minutes, money will adjust it itself, and I don't think they were really banking on this particular because of the Federal Reserve meeting going on. If the meeting hadn't been going on, it may have had more of an effect, but right now I think they're totally focused on the Federal Reserve more. And numbers itself, as you said, you were surprised. You were looking for this consensus with Bloomberg. the numbers are it's almost like an engine. 1 month numbers are good, 1 month the numbers are down, but the engine is still moving the car forward in a sense. The numbers are pretty poor at the moment. Over the last 5-6 years, these numbers are really tough to make investment decisions off of. Unfortunately, as I always support, your research, is that we can't throw them away. Unfortunately, we can't throw the numbers away and say, okay, they're not worth watching, because they are the only numbers they're part of that GDP. In other words, when you do the durable goods and you do the CPI and you do the TPI and you do the employment numbers and you put all these numbers together, and your research team is putting these numbers together, they're all building normally throughout the years and decades. They've been building to what's going to happen on Thursday, and that is the gross domestic product comes out. And people try to adjust their position, their financial position, on what they think maybe the number will be before it's released. And so today, you have a perfect example. You get the durable numbers, and they're way skewed off from where we anticipated them to be, or where the consensus was. And we're trapped. We know that the numbers are fudged. They're not the best numbers anymore. Not the specific individual number, but the numbers that we receive are very confusing, because let me just say this, and I'll let you go. But was it yesterday? Someone was saying that housing starts, I think it came out yesterday, and the numbers were, I guess they were bad. And someone said, well, yeah, there's 95 million Americans not working, and we have a 5.1 unemployment rate at the same time. So housing numbers show that there's no buying because nobody's working. In other words, it's, one number looks great and one number looks bad. That you could describe that for the last 7 years of the whole administration and the economic policies of the administration. One number looks great, then the next number looks bad. Then the next number looks great, and the next number looks bad. So in other words, we're really going nowhere. And the key there, as a trader, try not to handcuff ourselves into a position where we can't adjust. As Max says, true, FOMC seems to be the focus. Yeah, you're right. You're totally right, Max. That's exactly it. And money will move on those. I haven't even heard what the buzzword is. There's always a buzzword that they're looking for from the statement. So there's something they're looking for, and I haven't even tuned into what that'll be. But I can guarantee you by probably by about 7 GMT tomorrow morning, they will start to enlighten us what they think should be in the statement. And by like 11 and 12 GMT tomorrow, we will know what everybody is looking for in the statement. And then the statement will come out at at 2 p.m. Eastern Standard Time, which is 19 GMT. And then the statement will come out, and everybody will be looking for that one word or two words in the line, in a sentence. And you have trillions of dollars sitting on the side, and you have billions of dollars waiting to be invested, and they're looking for one word. Oh my God! Oh my God! Anyway, that is unfortunately, Polina, you asked me what I thought, and you got it. That's why we put Nash on Wednesdays to reel me in.
Why? Unfortunately, I look forward to that. Thank you very much. And yeah, I mean, as you said, if we would throw out all the numbers, what would be left out there? Seriously,
there would be nothing.
I wouldn't.
Well, no, but you know what will happen is that one day the numbers will mean something again. This is not going to happen. This can't stay this way. This is just a temporary moment in history where numbers have no relevancy, and that's not going to last. It just won't last, because money will need responsible information to make financial decisions. I think that's the best way to describe it, and they'll be forced. Once Mr. Obama is gone, which is under a year basically now, it's almost a year for the election itself. But once he's gone, these policies will be gone, and then numbers will mean something again. And so when you're looking at numbers in a year from now, you'll be like, oh, this is a lot different than what it's been for like the last 7-8 years. And that's what it really comes down to. So you can't. It's what is the old saying? Don't throw the baby out with the bathwater. The numbers are the baby. And the policies of the administration are the bathwater. So it's just we just have to put up with it for another 11, 12 months.
I love the epiphany. I love the epiphany.
I hear you. All right, well, thank you for asking my opinion, and it's always wild and it's tough.
Thank
Now,
you
Max, I found the volatility. I think it's Yara who does the volatility in the mornings on volatility on on the research on Mondays and Wednesdays. I found the volatility, so I'm going to go through that. It's an interesting hypothesis, I think, so it'll be interesting. So, all right, guys, thank you very much, and don't throw me out with the bathwater either.